The role of funds transfer pricing, FTP, in bank treasury management. In the complex world of banking, effective treasury management plays a critical role in maintaining financial stability and profitability. One key component of successful treasury management is funds transfer pricing, FTP. In this video, we will explore the role of FTP in bank treasury management. What is funds transfer pricing, FTP? Funds transfer pricing is an internal mechanism used by banks to allocate the cost of funds and measure the profitability of different business lines. It is essentially a tool that helps banks determine how much each business unit contributes to the overall profitability of the institution. Why is FTP important? FTP is crucial for several reasons. Firstly, it helps banks manage interest rate risk. By assigning appropriate funding costs to different assets and liabilities, banks can accurately assess the risk associated with their loan portfolios, deposits, and other financial instruments. Secondly, FTP enables banks to create an accurate view of the profitability of each business line. By assigning appropriate funding costs to income-generating activities, banks can determine the true profit contribution from each business segment, such as retail banking, commercial banking, or investment banking. How does FTP work? FTP works by assigning both a funding cost and a pricing rate to every asset, liability, and off-balance sheet item. The funding cost reflects the expense associated with acquiring the funds necessary to support these activities. The pricing rate, on the other hand, represents the return on capital generated by each activity. To determine the funding cost, banks consider several factors, including the interest rate environment, market liquidity, credit risk, and the bank's own creditworthiness. The pricing rate takes into account the market conditions, competitive landscape, and risk appetite. Benefits of FTP. FTP offers numerous benefits for bank treasury management. Firstly, it helps align the institution's business strategy with its funding strategy. By accurately measuring the profitability of different business units, banks can make informed decisions about resource allocation and capital deployment. Secondly, FTP facilitates performance measurement and incentive alignment. It allows banks to identify the most profitable business lines and incentivize employees accordingly. This can lead to improved overall performance and ensure the bank is capitalizing on its strengths. Lastly, FTP enhances risk management by providing a clear picture of the profitability and risk associated with various activities. Banks can use this information to optimize their balance sheets, mitigate risks, and make more informed strategic decisions. In conclusion, funds transfer pricing, FTP, plays a crucial role in bank treasury management. It helps banks manage interest rate risk, assess the profitability of business units, and align funding strategies with business objectives. By accurately assigning funding costs and pricing rates, banks can optimize performance, enhance risk management, and ensure long-term financial stability. Want to learn more? Claire Trithel on LinkedIn.